There are two types of people, those who find an extra $1,000 and go straight to Gucci, and those who find an extra $1,000 and buy more income. The first group looks rich, but they stay broke. The second group gets richer even when they're sleeping. In this video, I'll show you exactly what type of income to expect with your first $1,000 investment and how you can get started today. And just so we're on the same page, I'm not talking about starting a drop shipping store or starting a business. I'm talking about taking your extra $1,000 and putting that money to work. That way your money can be working to make you more money through cash flow. I'm gonna start by showing you 3 assets you can buy with that $1,000 and the different types of returns you can expect. And then I'm gonna show you how you can compound and accelerate your returns. That we can grow your money even faster. If you have an extra $1,000, you can take this money and put it into the stock market, and most people will hope that you can turn that $1,000 into $2,000. But when we talk about income, I'm talking about something a little bit different. I'm talking about taking that $1,000, buying some stocks, and then those stocks send you a check every 3 months called a dividend, and they deposit this money into your bank account. The nice thing about these dividends, this cash flow is you don't have to work to get paid, because now if you buy a share of, say, McDonald's, you don't have to work at McDonald's, but you get your share of profits from McDonald's. And the other nice thing about this is you can work to start stacking your profits, meaning if you can start to get a little bit of profits this year, you can get more profits next year, more the year after that, that way you can work to increase the cash flow, and then you can live off your investments without having to sell your investments. That's the best beauty. But not all stocks are made the same. Some are going to be much more risky than others. And sometimes more risk could equal more potential return. I mean, yeah, I could also go more bankrupt faster, but if you are starting with, say, $1,000, well, you might be willing to take on more risk because it's not a huge sum of money. It might be a lot of money to you, but in the grand scheme of things, even if you were to get a 10% return, well, a 10% return, which is the average stock market return a year, would be $100. It's not life-changing money. And this is why I want to talk about a few different types of investments, some more risky than others. That way you can start to see the different types of returns. Option 1, definitely more on the risky side, is a royalty trust. A royalty trust works like this. You own land, and under that land is oil. But you don't drill it, you don't touch the oil, you instead have somebody else do that. And every time this other company pulls that oil out, they pay you a little bit of money every time oil comes out. A royalty trust is the company that's collecting money from the oil and gas company, pulling the gas out from this land that's not theirs, and then they have to pay out most of their profits to the shareholders, people like you. The reason why is because royalty trusts are generally required by law to distribute 90% of their profits to their shareholders. The reason why I say this is more risky is because they don't actually run a business. They're not working to grow. They're just gonna keep paying until they go dry. Literally, when the oil is gone, they stop making money. A couple of the larger royalty trusts, and no, I'm not recommending these. Again, investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube or PBT and SBR. These are stock ticker symbols. So if you use any stock brokerage out there, there are so many. You can find one that you like. Just Google stock brokerages, see one that you like. These are 2 of the larger ones. And the reason why some investors like these is because you can see higher dividends generally. They're paying out generally in the range of 5 to 10% a year in dividends, which means if you invest $1,000, you'll be making $50 to $100 a year in cash flow as long as they're actually making money. The cons here are, number 1, you have volatility in the stock price and the amount of dividends that you get. Because, well, when oil prices are going up and down, the interest in these royalty trusts also go up and down. And so when the stock price changes, the dividend yield that you're getting also changes. Not to mention that when oil prices change, the amount of profits that these companies are going to be getting are also going to be changing. Just to give you an idea of what I mean, if a company is trading for $100 a share and they're paying out a $1 a year dividend, that's a 1% return a year. But if the stock price fell to $50 and they're still paying a $1 dividend, well, the dividend didn't change, it's just now a 2% dividend because the stock price has changed. The second risk is that it's a depleting asset because once the oil is gone, the company's gone. And risk number 3 is that these are generally smaller and thinly traded and can be impacted by the economy. If oil prices jump up to $100 a barrel, well, they'll start making bigger profits. If oil prices fall, these companies will get hurt. So will your dividends. So here we have something high risk paying out 5 to 10% a year. On the complete opposite end is a lower risk investment like a treasury. A treasury is when you lend money to the United States government. We all know that the United States government has a lot of national debt, and they can borrow their money from people like you and me. And when you lend money to the United States government, you are the bank lending money to the United States government, and in exchange for you giving your money to the government, they will pay you with regular interest payments. Now, you can lend your money directly to the government by going to something like Treasury Direct, or you could do it on the stock market by investing in an ETF that gives you exposure to these treasuries. A couple examples of this would be SGOV and SHV. SGOV is a fund that gives you exposure to short-term treasuries, generally 3 months or less. And SHV is very similar. It also gives you exposure to short-term treasuries. This time they're generally 1 year or less. And both of these ETFs are paying around 4.5% a year in dividends. Now, the interesting thing about this is that these are backed by the United States government, because when you're lending money to the United States government, well, you're protected, because if the United States government goes bankrupt, the whole world would feel the pain. And this is where you have a little bit of protection, where you'll see that the stock price generally does not move. The only time the stock price moves is when it pays out its monthly dividend, and then the stock price will drop by the amount of the dividend. So you're really not seeing a variation in the stock price, you're just generating interest, and this is a way for you to generate the interest by doing it through the stock market. Now, yes, this is not FDIC insured, because you're not putting your money into a bank, you are investing your money. However, you are protected because, well, you are backed by the United States government, and if the United States government collapses, you're not going to get your money back. But there's going to be a lot of other problems that play here too. And the other nice little benefit here with these treasuries is that because it is lending money to the United States government, you're generally exempt, meaning you don't have to pay state and local taxes on the income that you get from these. So these are paying out around the 4.5%. And the one last con here is that you're not actually going to see any growth in the value of your investment. You're only investing in this for interest because, well, it's a loan. And the third, and probably the most traditional way to do this, which we'll call for this example, something of middle risk, would be to invest your money into stocks that are paying out dividends. Now, I want to remind you that if you are an investor or want to become an investor, my team at Briefs Media publishes a free daily report called Market Briefs, where we're breaking down what's happening in the stock market, housing, crypto, global markets, and our own economy into a fun, weedy, and easy-to-read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning, and when you join Market Briefs, you'll also get an investing masterclass as a bonus for free, where I break down how you can get started as an investor and find hidden investment opportunities before anybody else. So if you want to get Market Briefs plus my investing masterclass all for free, all you have to do is click the link down in the description below. There are companies like McDonald's that are making billions of dollars a year in profits. And when they have this big profit, they can do three things. They can save this money for an emergency, they can reinvest this money back into the business, or they can take this money and give it away to shareholders, people like you. And this is where a dividend is one way that companies can give it away to shareholders. And generally, these dividends are paid out quarterly, meaning every 3 months. Now, the difficult part here is to find the right company, because yes, McDonald's pays a dividend. And if you keep investing your money into McDonald's, that might be great this year, next year, the year after that, but in 10 years, it might go bankrupt. Who knows? And if they do go bankrupt, well, that means not only do you lose all of your cash flow, but you lose your entire investment as well. And this is where, if you don't want to keep up with all of your stocks, the alternative is to invest your money into a fund that specializes in dividends. A couple examples here are SCHD and NOBL, and as a disclaimer, I'm personally invested in SCHD. SCHD is an ETF, meaning a fund created by Schwab, and this gives you exposure to a broad basket of United States companies that specialize in dividends. So this is investing in hundreds of dividend-paying stocks, and instead of going out and investing in those stocks yourself, you can invest in this fund and get exposure to those dividend-paying stocks. If one company, say McDonald's, goes bankrupt, well, the fund would kick it out and replace it with a different company. NOBL is a little bit different. Noble is an ETF that gives you exposure to dividend-paying aristocrats in the S&P 500. What does that mean? It's dividend-paying companies in the S&P 500. Meaning these are some of the 500 largest companies in the stock market. If it's not one of the 500 largest, it's not going to be in the S&P 500. So it's in the S&P 500, it pays a dividend, and it's a dividend aristocrat, meaning it has paid out and increased its dividend every year for at least the last 25 years. So these are more historical longevity dividend paying companies. At the time of recording this video, Noble is paying around 2% a year. SCHD is paying around 4% a year. So if you invest $1,000, you're gonna get $40 out of here, $20 out of here in year one. Now the real pro here is you're not taking on a whole lot of risk, but you have a lot of potential upside. What do I mean by that? Number one, in addition to your dividends, you can also see the value of your stocks go up, because the idea is to own good investments. And if you own good investments that are making bigger profits, in theory, they will also become more value, which will make the value of your investments also more valuable. Number two, if these companies are also making bigger profits, in theory, they should also be paying out bigger dividends. So hopefully the goal would be to not only get the dividends today, but next year get bigger dividends, the year after that bigger dividends, and on and on and on, because you are investing in the profits of these great companies. Now the risk is, of course, you're investing in stocks. If the stock market crashes, you can see the value of your portfolio go down and the value of your dividends go down as well. Now that you understand three different assets that you can start in to invest that $1,000, let's talk about how do you actually compound your returns, because what we've seen now is if you invest $1,000 and you get a 2% cash flow, that's $20 a year. If you get a 10% return, that's $100 a year. How do you grow and compound that? And the way you do that is a 1, 2, 3 punch. Punch number one is be consistent with your investments. Instead of investing $1,000 one time, invest $1,000 a month. If you don't have $1,000 a month, invest $500 a month. Don't have $500 a month, invest $100 a month. Whatever you gotta do, keep investing, whether it's every week, or every 2 weeks, or every month. Keep consistently buying. Punch number two is reinvest your profits. When you invest $1,000 today and you get your first $40, instead of taking the money and going to Benihana's, take the $40 and reinvest it back into the stock, into the fund that paid you the dividend in the first place. That way now your money is making you money, and then you take the money that your money made and you use that to make you even more money. That way now you bought a machine that's printing you money, and then you take the money that the money printing machine is making you and you use it to buy even more of the money printing machine. And punch number three is to grow how much money you're investing every week, every 2 weeks, and every month. If you get a raise, invest more money. You get a bonus, invest more money. You start to get a new job, invest more money. Now, as you work to increase your income, you're also increasing how much money you're investing every month, every year. That way, now you have more money working to print you more money. This is a 3-punch combo to compound your returns, because the reason why everybody gets turned off is they say, Jaspreet, I'm gonna invest $1,000 and I'm gonna make essentially nothing. And you're right. In the beginning, you are gonna get essentially nothing, but I call this a decade of sacrifice. If you stick with it for a decade, where you work to spend less and earn more so you can invest like crazy, you are not going to recognize yourself at the end of the decade. Because in the first few years, you're gonna keep putting money in. You're gonna keep consistently investing every month, and you're gonna get essentially no returns. But every time you get that dividend, you're just gonna keep reinvesting it. And if you get a raise, you're gonna keep investing more money as well. But this is where things get interesting. You do that year 1, year 2, year 3, and you get essentially no returns. But then year 4, you get a little bit of returns. Year 5, you get a little bit of returns. Year 6, a little bit better returns. And every time you get those dividends, you keep reinvesting them. But now, here comes year 7. You're making actually more money now, 7 years later, and so now you can invest more money. So every time you get paid, you're buying more of these dividend-paying stocks, and you're also getting bigger dividends, meaning you can reinvest more every quarter, and you're consistently investing. So every quarter, you're getting bigger dividend checks, and now it's starting to become something actually sizable. Year 8 is even more sizable. Year 9 is even more sizable, and you're making more money. You keep investing more. You keep reinvesting those dividends. You stay consistent every week, every 2 weeks, every month. You keep investing, and now year 10, well, now you have a very solid stream of income. It sucked for the first few years because you keep putting money in and you're getting nothing out. But if you stick with it through the decade of sacrifice, that's how you can build a new solid stream of income. And that's the sacrifice that most people are not willing to go through. If you really want to see that compound effect, you really want to see that big cash flow start to come in, you got to understand it's going to take time and it's going to take sacrifice. And I know a lot of people on the internet talk about how you can make all this money without doing nothing. Well, it's a whole bunch of crap. So if you actually want to build wealth, here's what you got to do. Now, don't go out and just buy the riskiest things. Find good investments that can grow over time, and then stay consistent with it. If you make $80,000 a year from your job, you need to make $80,000 a year from your investment income to be able to quit your job and live your life without changing anything you're doing. With your job, you have to go into work every single day to keep getting paid. With your investments, once you put your money to work, it'll keep paying.